All right, guys, glad to have you on board again today. As you can see, I've finally found the time to restore the beauty of this dashboard, at least portion of it, that were malfunctioning for quite some time now. So we finally have a way back into the dumb money sentiment. And this week, I think we're going to find some time talking about the silver. I've had multiple people saying, yeah, Phil, why the heck is going on with silver? Why doesn't it break resistance and stuff like that? Part of the answer to me is this extreme bullish sentiment in the dumb money side. That means people are trading with margin, the money they don't have, and therefore that the one that borrow at the market maker's ends. And that's basically the way it goes. It just forces the market maker to play the time variable and say, okay, you know what, you're going to pay me so long as the price doesn't move, you're going to have to pay me interest. Quite high interests, by the way. So in that front, well, the broker is just, well, I don't care. If the market really goes up, I'm going to have to buy it. But as long as it doesn't do anything, I can just do nothing. And I'm not going to cover your positions. I'm just going to cost you the interest. And that's really the way it goes. When you have such high difference between bullish and bearish exposition, that means the market will have to buy if the market goes up. But as the market maker makes the market, do you really think it has an incentive to buy the market early? No, it's just going to say, okay, you know what? So long as there's no true fundamental prime market catalyst to push me up, I'm not going to do it. I'm just going to say, okay, you know what? You want to buy with the money you don't have? All I'm going to do is just play the time and get the interest out of your ass and just wait until there is a good reason forcing me to buy. So I've always said this is one of many, many, many factors and catalysts in the market. But when the retailers are trying to time the markets so precisely that they're borrowing the money they don't have to do so, that just forces the market maker to play around the time variable, the time premium. And that's exactly what I think is at play with silver. We're going to look at the charts, of course. That being said, same old story as we always do. We'll see the difference there is in terms of sentiment perception between the stock market and the crypto market in a more smart money way sentiment. As you can see, for a smart money manager, it's not the end of the world like people feel like there is, in which they fear of constantly lower lows. I mean, we're inevitably back to 20K when it comes to Bitcoin. We're all going to die. Yet another desert crossing phase. It's going to be pain over and over, folks. You're all going to die. Well, like I said, I mean, if you look at the sentiment, it's clearly not stating a picture. And if you look at the broader picture of sentiment, well, it just says one thing. Okay, we can spend some time below 50, but in my humble opinion, the next stage is above 80. So the next phase of market is going to go overbought, and there are multiple other factors suggesting this is just going to happen. Now, if you think you can time the market and say, yeah, 2 weeks from now we'll be there, well, good luck with that. As you can see, it's taken quite some significant amount of time to build the latest bottom until we got higher. So I think the next way is higher. The question is just how long are we going to stay into this neutrally, slightly feared type of sentiment? Now, of course, we've gone from kind of greed into fear, so people think the next is extreme fear. I think the next is extreme greed, but that doesn't mean we'll get there for now. For now, we're in fear mode, well, so long as people do these kinds of things, like heavily piling up bullish positions, well, the market makers, like I said, will just do nothing but let the time run. So that's really the way it goes. In terms of timing catalyst this week, well, it's not going to be that crazily important. We're just going to get a core CPI who can help eventually switching probabilities in terms of federal funds rates, futures Fed funds rates, which we're going to have a look at. Despite that, well, like I said, not many very, very interesting types of catalyst. This week around, we're going to get the ECB, which is expected not to move anything. So very, very crucial to see if the ECB surprises the market for one reason. I mean, I think these numbers aren't right. I think the ECB is expected to rise 50 basis points. So let me just take a stand back from this. But if the ECB raises interest rate, we'll see all about that. Okay, so that's what's expected, though, for euro dollar will be to be studied next week. We'll say this. Okay, quick look at our other fundamentals or macro kind of context. We'll see that when it comes to the US dollar, the treasuries are still being replenished, and they're mostly being by the money that's taken out of reverse repos. As we see, the net liquidity is just not moving. We'll look at the charts afterwards. When it comes to the expiration at the end of this week, remember Friday is a quality expiration for witches type session, so expect volatility because the broker in here is, of course, forced to push prices higher, and we're probably going to close above the max pain price, which is currently at 4,400. And there are reasons for this because the IV is imbalanced, and basically it forces the market maker to do the same old thing as we said. There's much more short sellers and put trader than there are call traders, forcing the market makers to kind of close them in a pain trade. That's where the way it goes. Okay, like I've said, this is just derivative stupid shit. Of course, if you're trading on investment types strategies, these are all like the short-term arbitrages and stuff like that, which you should normally not pay too much attention when they don't go extreme, which is not the case in here. It's just there's slightly more bearish queue in this market, which just forces the market maker to just either wait before going lower or just not going lower anyway. But that's where the way it goes. So expect that next week could be a bit volatile because of these four witches. If really the market is headed for a bear cycle, well, we could eventually start it throughout the later stages of this week or early next week, when, of course, all of these upward short-term arbitrage price pressure will be removed. That's where the way goes. When it comes to CPI data, as we mentioned, we're going to have to look at trueflation, which is still standing somewhere below 3%. So what I'm caring is, are we going to increase again the wide distribution of these two numbers, or are we going to decrease the spread between the two? My hunch is probably going to maintain or slightly decrease. CME Fed Watch for the futures fund rates still state clearly that nothing is going to happen in September, and odds are these are the numbers we're going to have to pay attention to out of the CPI release, because this is the ones that are going to move. We'll see all about that, of course, next week after the numbers have been released and the information's been digested by the market. When it comes to cryptocurrency, we look at still the longer term end of this stick. As you can see, we might have finally find our way into this bottom, lower than I initially expected. I'm still waiting for the moment in which we get the hell out of this very pain trade in which, well, just nothing happens and people just pile the money into Bitcoin. Well, like we said, Bitcoin is a long game. If you're really in this thing for 30, 40 years, yeah, of course, Bitcoin is by far the best vehicle, but it's certainly not the most rewarding in terms of risk-reward balance. Yeah, sure, Bitcoin is probably going to make it a highly certainty of doing such a thing, but the rewards being brought down by Bitcoin are much lower than the other ones. Remember, this is always, like the market goes, there's a risk curve, and it's for up to you to position yourself. So right now, of course, nobody's willing to take risks, and that's the translation of it into this market. I'm just waiting for the moment in which the market will balance. Remember, the sentiment, the crypto sentiment, is expected to go extreme green. That means normally people should take on their Bitcoin gains or take their Bitcoins, collateralize them, whatever, should just go higher in the risk curve. Until then, what we see is just this is a matter of timing. And that's going to be the repetitive element of this session. It's all about timing. And the problem is that a lot of crypto traders, and not just crypto traders, are thinking that they can predict the time. When it comes to investment type thesis, the ones we're talking about in these channels, in these weekly reviews, these investment timings, you just can't time the market. So just try to be smarter than that. Just buy the underlying asset. Be patient instead of just trying to time the market all the time by borrowing the funds you don't have. It's really the dangerous stuff now, and especially even more in stagflation. Remember the stagflation environment, which we've predicted for somehow over more than a year. We've predicted it will be in stagflation. You got to get to be ready for this. That means the money is going to be rare. Borrowing money is going to be stupid. And now we're exactly into this moment in which the retailers are doing exactly the opposite. We know that the brokers will play time because the market is complicated to navigate. It's mostly going to be ranges all over the place. And yet people think they can predict the bottom of ranges, which I told you all the time, you can't. So just try to be smart, guys. Just buy assets that have valued, that have been absolutely destroyed. Buy the value, sell it at the median price. Don't try to catch the things that go to the moon. And on the other hand, please don't borrow the money to buy more of the assets to make more money. Just try at least to follow the money where it goes and try to be patient. Those who play timing the market inevitably going to be end up penetrated. That's my hunch. Okay, on this other end, we're following Ethereum narratives, and I'm going to have to mention this. Last week was inflationary and terminating a flat kind of 30-day period. So we're going to have to monitor this because my hunch was kind of the opposite. I expected September to be an uptick in Ethereum activity. What we can see in here is that this is starting to diverge from my personal modeling. Instead of having more activity as people go back to their trading desk and so on, we kind of have the opposite way around. So that might be the sign that eventually I might be wrong with my timing assumption in here as well. Going to have to be monitored next week as well. But for now, it seems like activity is going down on the layer 1. Turns out it's not the case for layer 2, which is still making all-time highs in here. So it's the same old story that depends on where you put your lenses. And really, that's the way it goes. If you look at the market in terms of layer 2 scalability, well, these things just keep going higher. It definitely looks like a parabolic skimming thing is on the verge to come. And there are multiple things interesting inside that. And the huge battle there is between base and Zkissing era, which has two different ways and two different visions for the future. So very interesting to me to see these things as they play out over time. But net, we're just going to have to see, of course, layer 1 activity is going lower, but layer 2 activity definitely isn't. So very curious to see how these things will play out in the next weeks. When it comes to a validator balance, we're still having kind of the consolidation trend. It still leads me to believe that halfway through through October, we're going to find a net balance in which the supply and demand for validators will kind of balance more perfectly. That's the way it goes. So everything seems to be fine. It's just that there is data points to be confirmed by the next weeks with an S to look for the on-chain activity on Ethereum and how prices will react to this. Okay, that aside, let's go straight to S&P 500. As same old story, we're still trading that bearish resistance territory. It's not an area to be bullish, like Roman mentioned. There are no reasons to be bearish in here as well. We're just in a resistant context, and boy, well, that just means there are going to be fewer buyers in here. That doesn't mean everybody's going to short sell and get rid of their stocks. Let's dump it all before we're on the edges of 90.97. I see some perma bears just yelling all over the place. The same story. The market has intrinsic fundamental problems. It's all going to crash. I've heard that dozens of times, like really, really dozens of times throughout a decade of trading. Like I've always said, it's just, well, sometime it may happen, but until then, these guys have just been so painfully proven wrong all the time. So I'd rather like to be taking a hard hit on 97 like type style, but until then, well, just betting on this constantly is very dangerous. There are some problems underlying the market structure, and we've mentioned that the distribution of market is dangerous. Just concentrating on top 10 stocks isn't a healthy type of market, and it's definitely not consistent with stagflation. In stagflation, of course, we should see market rotation. So I'm still waiting for this to be proven, my thesis. All the other metrics have proven. We start to figure out that there's a bottom in inflation. We start to figure out that the actual unemployment data is starting to tick up now. So there is hardly any other way around but stagflation as a conclusion. And in stagflation environment, the market breadth can hardly be just the top 10 stock making all the gains. That's what I've always said. We'll see all about that, of course. So far, it's just a metric that tends to fail to prove right. But that's the same story. It's just a matter of timing. We're in an area in which if you're making that bet of just concentrating all your portfolio in 10 stocks, to me, that's just absolutely not making any sense. You're below the context. That means this is the worst possible time to do that bet. On the other way around, well, if you made that bet higher, well, good luck with that. That's the area in which you should take on some very juicy gains. But that's always been my thesis for the latest month. It's now the time to start reweighting the portfolios to some lower caps than these top 10 names. That's really the way it goes. On the other hand, well, we mentioned liquidity is the number 2 critical factor. The liquidity is not drained in the market or out. It's just really kind of nothing happens in terms of liquidity. It's an absolute perfect balance in just how much money goes out on reverse repos and the money that collects from treasuries. So that just says it's like nothing happens in terms of net market liquidity. And of course, we've seen that this is where the moving average is. So sooner or later, we'll find a way into bringing liquidity in the market, either because something is going to hit and money is going to have to be printed out. One way or the other, we just know that some money is going to go into the market. Is it going to be net diluting the dollar value? Therefore, everything goes up. My bet on this front has always been the same. This is the past, and everybody think we're going to repeat that. Yeah, money printers go brrr, so everything goes up. I doubt it. I doubt this will ever be the metric anymore. If we're in stagflation, it's really more like everything that's been unduly destroyed will go back to the mean. Everything that's been duly destroyed because it's just full of leverage and debt and produces no growth will have to die. And the net equilibrium of these things means the stock market isn't going to go to the moon or to the cave. It's just going to come to stay in some form of range. It's just a matter on how fast the rotations will happen or not. And that's the way it goes. And same thing goes for crypto. Now crypto is entirely destroyed, like it's all going down to zero. And I doubt everything is to the garbage. There are some valuable assets that are sufficiently decentralized, that have long-term visions. Just keep building throughout the bearish times that we're in. And I'm very much concerned about the trader sentiment, which was all like, yeah, I would like to make money now. I've invested into this thing. I believed into the asset, but now that it's going down, I'm kind of pissed off. I'm going to get out. But like I've always said, if prices go down, that's just because of this stupid sentiment. As I said, we have all the metrics suggesting that we have found a way into extremely oversold territory type prices. So if you want to invest, that was just pick and choose. Just pick whichever asset you think is worth it. Just buy it. Just be patient. The stops are zero in terms of low risk strategy all across the board. That means whichever asset you pick on a weekly basis as a stop loss at $0. So what the fuck is wrong with you? Why the heck would you like to buy with the money you don't have? Why the heck would you like to put a timing constraint into your trading strategy just because you want to make more money than you could already? I mean, just look at the potential rewards. All of these assets, if they just retrace to the mean, they offer 4 to 6 to 10x. So what the fuck is wrong with you? You have an investment opportunity that could return a 4x only if you're able to pick up the right guys. And like I've always said, you just can't get them all. So try to disperse the money and understand that you just can't strike the perfect answer and find only winners. They're probably going to be losers in your game, but that's the way it goes. Pick, choose, wait. Don't leverage, because whenever you leverage your trade, the only thing you're actually doing is just sending the message to the market maker to do nothing, to just stay there, keep pain trading you, and win from the margin it takes away from you every day. That's the way it goes. Just try to get through this. I don't know. Some of you guys have few $1,000s invested in the market. And when you scroll through the social medias and shit like that, you see people gambling with millions. And you feel like, yeah, it just takes a little bit of margin and I can be just like this $1 million guys. Well, just try to be smart enough, okay? If the $1 million guys just plays with no leverage, it's probably going to make an hefty returns if he's able to pick up the nice assets. Well, on the other hand, you trying to play on another league into which you probably belong to, it's just going to make you a loser. So try to understand the way it goes. Get out of fucking leverage. There is no leverage to perform in these current times. It's just let it happen. It's going to go back to the mean for the assets that are worth it. There's no way for you to know which ones are the good ones and which ones are the bad ones until we get there. And that's the way it goes. And if you cannot accept that simple thesis to say everything is extremely oversold, we're in an absolutely depressed market sentiment, which is even further down the curve in here for crypto, because it doesn't even belong to the sentiment that the smart money does have. There is in here a negative premium when it comes to crypto. That means crypto is even more under pressure than the stock market is. But the truth is, well, if you've made those investment assumptions, well, that's the way it goes. There's no way for you to change the thesis all along. If you've gone into crypto, it doesn't matter which price you've paid. The number one mistake to say is, well, if you just want to buy the low, buy the dip, be among the ones that will be able to showcase their beautiful trades on Twitter to say, look, I bought right here and right here and right here. And I mean, good luck with that. We all know that's not how it works. So try to be smarter than that, okay? On an investment thesis, which is exactly what we're talking here. Okay, remember that when we talk about short-term trading, margin trading, and stuff like that, we do cover those time frames as well, but only on the Wednesday podcast that are recorded into YouTube. What we do in here in these weekly reviews is looking at investment thesis. In here, I have absolutely no signs of change. The only thing that's worth noting this week is if we see a persistent downtrend in the layer one activity on Ethereum, some things might change in the thesis. But until then, well, it's compensated by layer two activity. So it's hard to say for now. So long as we don't have the blobs and the protodank sharding, for now, layer two activity still translates in demand for layer one and heavily. So I'd like to state it one more time. These are dangerously timed bets to say, yeah, if layer one activity goes down, then maybe we could get cheaper ETH. But on the other hand, if it starts going up, then you know the machine is going to to automatically feedback positive loop itself this way. We all know that. If it goes higher, that means sentiment will go higher. If sentiment go higher, that means momentum will increase. If momentum increase, that brings even more people to say, yeah, maybe it wasn't that bearish. And that's the whole thing. It's just a binary market now. Either it does nothing and it stays into the range which we're in for more than a year now, and that's not more bearish or bullish than what it was a year ago. It's just we're pretty much trading the same prices. Yet the feeling is that as nothing has happened to prices for a year, that means this thing is dead. This thing is going to zero. The truth is, nope. Everything points to the fact that we're just pain trading everybody who's playing with leverage. Just let the leverage traders die and we'll go up again. So just try to be smart. If you want this market to go up, just don't margin trade it. It will automatically play itself. Just give it some time, folks. Don't try to time the market. That's today's lesson. That being said, I'll see you guys next week after the CPI data. Maybe a catalyst, we'll see.